Okay, I want to move to CPI. We have to talk. We're not going to talk about it too long because getting into the weeds, talking about CPI, I'm not a classically trained economist. I play an economist on YouTube, Griffin. Mm-hmm. I practice economics while we buy real estate here in the Midwest, multifamily. But again, we're not necessarily a tool to go into a deep discussion overall over CPI and all the math that's behind it. We can do that another time. But we have to read some of the headlines and go over some of the controversy because there's a lot of controversy. We had this Wall Street Journal article saying, inflation eased to 2.7, report distorted by government shutdown. And people are really confused about, where we are with housing, where we are with rents, and what does, this recent CPI report mean? And if we didn't have a report in October, is it meaningless? And what does it say? What does it not say? So top line, CPI gained 2.7% in November versus a year ago. Core fell to its weakest annual gain since March 2021 at 2.6%. Housing CPI maintained its tame or pre-shutdown pace at positive 0.2%, which averaged over September to the November period, which lies the controversy. Energy CPI inflation really accelerated up to 4.1%, and then services less shelter inflation saw an average 0.2% gain from September to November. So the controversy, the rub, everyone is saying, look, we had this government shutdown. We don't have any data from October. You're taking September's data, and now you're taking November's data. And you're just assuming the rents were low in October. You can't just assume that. That means the data is all wrong, and maybe we have higher inflation than we actually did. Mm-hmm. There was consensus for around 3.1% of year-over-year inflation from a lot of economists. And so everyone has kind of had their feathers ruffled because 2.7 didn't align with their projections. Here at the Gray Report, we've been anticipating CPI to come in really for the last year and a half. What's been frustrating is all related to owner's equivalent of rent, which is how CPI computes housing costs. And it's basically their method to take housing and translate it into a service. And it is not real-time market rate rent data. It's trying to understand just kind of the cost of housing for new leases, current leases, and just overall generally what people are paying. Here's the problem. Rents have been flat or negative for the last several years, but rents, according to CPI, have been growing by 3 to 4% for the last several years. And the idea is that the CPI, OER, and shelter index is supposed to be lagging between, call it 9 and 15 months, call it a year. Different people have different time ranges. It really doesn't seem to catch up. And so people are wondering then, okay, well, we don't have October's data. We don't know what rents, the direction of travel in October, but we know exactly the direction of travel in October. October was one of the weakest months for rent growth in years. It was slow. It was no different than the September print. If anything, it was lower than what we had anticipated from the September print. And then going into November, it paints a similar story. So it's low rent growth. And so this quote, there's a quote here from UBS, Alan Detmeister. Quote, "I think you largely just put this one to the side. Maybe this report gives minor downward sign for overall inflation, but the vast majority of this is just noise and should be ignored." We were looking for any kind of data, any signal over the last month during the government shutdown. They actually put out a report, and now it's just noise. It needs to be ignored, which I was telling you, as soon as folks from UBS start saying, don't look at this report, don't look at this, look over there, that just makes me want to look at it even more. Right. This is making me even more confident in just given what we're seeing at rent levels, the fact we have 500,000 units still in lease up, we're going to see slower rent. Mm-hmm. And that rent is not going to turn around on a dime. We see all this new supply that's still coming online. Rent and OER on CPI has acted as a buoy over the last couple of years. Lagging, it's keeping everything high. It's dragging inflation up, at least the CPI print. If we look back into March when actually CPI bottomed out to almost like 2.2%, if we had adjusted for real-time market rents, CPI would be below 2%. It would be below the Fed's target.
Yeah.
And so with no evidence and no ability for rents to really increase, whether it's market rates or in the CPI, we're going to see, lower CPI prints, or that trajectory lower over the subsequent months and over the next year and a half, up to 2 years. Again, shelter makes up over a third of CPI, and it's going to be this anchor. Even if you have services spike up, shelter is going to be bringing it all down. What this means is, at least for the Federal Reserve, in shorter-term interest rates is, I'm not saying we're going to see a lot of rate cuts next year, but interest rates are going to be at least slowly moving lower over the next several years, not higher.
I'd like you to pull up the Jay Parsons LinkedIn. If you could do that, I'm going to give you a little bit of time. And I'm sitting here kind of smirking as you're discussing the presumable direction upon which inflation can go. I've got a neighbor across the street. He's a little bit older, and he has come over a few times to help me, a new homeowner in the yard.
Yeah.
I've got a few trees that I need to remove, and they tend to lean one way. And he'll look at it and he'll say, well, there's only one way that thing can go.
Yeah.
And you sound like my neighbor when he's looking at my trees, because there's no way that thing's falling the other way.
Yeah,
right?
gravity.
With all of the data that we have in regards to housing, the direction upon which we know rents will continue to go really throughout probably the first half, if not the entire year of 2026, how can inflation go anything, maybe but down or up? And there's other factors involved, but with the visibility into the housing data that we do have and the rent data that we do have, it seems like you're looking at inflation kind of like my neighbor looks at my trees, saying there's only one way that it can go.
I mean, that's the preponderance of the evidence, at least right now.
Right.
And again, evidence could pop up that changes the narrative. If we really start accelerating, we had a strong GDP print that came out. I think we've got 3.4% GDP growth for Q3, which is really strong GDP growth. Well above estimate, above trend. With lower immigration, that increased wage pressure. Wages increase. That all leads to inflation. I think there's this idea that we've had pressure from tariffs, but that's a relatively kind of a transitory event, that we see price increases once. The caveat there is not everybody increased their prices at once, and that they've been kind of tapered in over time as producers and importers have been slow to pass some of those costs on to the end consumers. I mean, we're waiting for a Supreme Court decision whether those IEEPA tariffs are going to stay on or they're going to go off. It may cause some disruption, but generally I think things are going to stay relatively the same. So, there's an argument that we could see some more inflationary pressures. Reshoring, making more stuff in the United States is probably going to be a little bit more expensive than having a fully globalized supply chain. But I don't think we're going to have a balanced approach. I think we're going to have secure supply chains. We're going to make some stuff here while also importing elsewhere, because I think the free market is way too strong and powerful. Because if Vietnam's making something for a fraction of what we can make it here, we're probably going to import it from Vietnam, right, even if we pay a tariff. Right. So we do have some reasons that inflation could kick up, but then we also have AI, which is in technology, which is a great deflationary pressure. Increased productivity, we can make more with less. That means we can have, we can produce goods cheaper. People, their dollar theoretically can stretch further to buy more things. Maybe not all things, maybe not housing, but look at technology with what you can do with a phone or computer compared to decades ago. It's pretty incredible. I mean, just look at what you can get accomplished with Gemini, ChatGPT, or et cetera. It's pretty amazing. How that exactly translates into gains, some is yet to be seen, but I think most people would acknowledge that there are some real gains. Obviously, we bring in the employment picture, and does that increase unemployment because, firms aren't hiring as much? Right now, we're not seeing a lot of, and we're seeing some firing, we're seeing some layoffs, but it's not widespread. We're also seeing less new government jobs. And so, instead of adding 140,000 on average new jobs, a lot of those were public sector jobs, government jobs. Now we're seeing a lot of folks come off the government payroll and adding less to the government payroll. And so it's just less robust job growth, but maybe it's a little bit more like real economy job growth, which may be a little bit more imbalanced. We also have demographic shifts of, maybe we lose all these jobs, but we're also missing a lot of people. Gen Z and Gen Alpha are much smaller generations compared to millennials and the baby boomers. And so we're kind of like, if we don't have immigration coming in to fill those gaps, we're going to need robots or somebody to do the work.
And they're coming.
They're coming, and I think you have to have you either have to be an optimist or an absolute pessimist.
Right.
I mean, and not that there can't be some volatility and muddiness in the middle, but I think it's either going to, full-on Arc Raiders post-apocalyptic scenario with AI, or things are going to be pretty good.
Utopian versus dystopian at some point.
Yeah.
We were talking about
scarcity,
CPI,
maybe.
And I had you pull up this Jay Parsons post. I think it's a great summary for those of us
somehow we got to post-apocalyptic.
Yes, we did. I think it's a great summary for those that otherwise maybe don't have time to dive into all of the details that can impact CPI. But I think the most important thing for what we're talking about here today on the Gray Report podcast is that last paragraph, and it could involve a few of the texts above, but it essentially just says any real pickup in CPI or rent and shelter is unlikely to show up until 2027 at the very earliest, more likely in 2028. Maybe, there it is. Just based off this 12-month lag, you said maybe 9 to 15-month lag. We've had negative rent growth across the nation for the entirety of 2025. So that means in 2026, obviously, that data will begin to show up in CPI. What are your thoughts, I guess, on this Jay Parsons post in regards to, kind of the overall picture and theme, as well as that paragraph you have highlighted there?
Yeah, I think he's keeping everybody honest and just level setting of saying, hey, guys, let's all just settle down. It's really clear of why we're seeing rent deceleration and that we're going to continue to see it. And that rent deceleration is going to be an anchor keeping CPI low over the next at least a year. And again, so let's say it's 12 months on the dot. We've got negative rent growth today. Well, that's at least 12 months. All of our forecasts are showing that the first half of 2026 is going to be pretty damn weak.
Yeah.
So that's at least an 18-month period before we see any kind of acceleration or really true growth, or positive growth in the shelter component of CPI if there is that 12-month lag. And again, it's 12 plus months. We were tracking this every single week. We're waiting for rents of CPI to start coming down because the market rents had been coming down, and at 12 months we've said, okay, now they should start to be coming down. It's a 12-month lag. Well, CPI rents kept increasing, right? And not just, obviously they're increasing month over month, but it's the rate of growth was increasing. When it's like, no, the rate of growth should be decreasing substantially. And in fact, rents are negative. And so when is this going to show up? It took well over 12 months, closer to 18 months. So we're going to have a long period of where just CPI, there's just not going to be the argument to say that inflation is really high. Even inflation may be high in some areas. We could have energy inflation. We go to war with Venezuela or something.
Yeah, sure.
But, and that will certainly impact things. But shelter should keep things relatively lower. And market participants, investors, economists even have relatively short-term memories, and we're going to kind of forget about all of this for a while, and we're just going to know that, CPI is saying that inflation is, closer to 2% than 3%.
Yeah, I think this last paragraph too here is what he's saying exactly what you just said when I was talking to you about my neighbor with the trees, upon which there are other ways it could go, and there's other factors that come into it, but it's simply kind of outside of, obviously, his wheelhouse and also ours. But
tornado comes through, whips that thing the other direction.
Right. There
Black swan.
Could be other things. This is also kind of a visually stunning graph from what I think is some pretty long-standing data. You kind of look how flat inflation was from, 2013 to 2020, and then we saw a dip in 2021, 2022, and then it just kind of took off.
Yeah. And again, we still have room to go because the rent growth has been lower than pre-pandemic average for a little while now. And so it's not like we're going to flatten out here where we were, and that's going to be the anchor. We're going to get down to, I don't think I don't see any evidence where it goes negative. We'd have to have like deep negative rent growth for a long period of time, just from my understanding of how OER is calculated. But getting down to that kind of 2% range is very reasonable, and maybe a little bit lower than 2% on CPI for shelter.
It's interesting just to see this visual in the pre-pandemic average versus where we stand today. Like you said, the data for 2025 should show up in 2026. There could be a long way to go down. It would be interesting to see how low it does go.
Yeah.
Or could go.
Again,
a lot of things got to go right.
As we were saying that, I was like, well, 2% of it can get at least down to 2%.
Yeah, the Fed's arbitrary target.
Yeah, and and let's see if they reassess that. I think that they kind of want to, but listening to Scott Bessent, recently in an interview that he did, they even though that argument can be made, and I think a lot of people want to make that argument that maybe the long-term inflation target should maybe not just be 2%, maybe is it 2, is it 3? The conversation was it being 3 when long before all this happened. I mean. 10 years ago, we were talking about the target. Should the target be 3? Because there was no inflation. And so maybe we need to stimulate a little bit more to try to get a little bit of inflation to maybe average out, at 2%. Sure. And so, but now the argument against shifting that is, are we moving the goalpost that every time we find ourselves out of target, do we just change our goals when we're out of target? But when you've come back and meet your goals and you're on target, then that gives you the ammunition to go out to the public and say, now we're going to readjust our goals because we think this is the right decision, even though we have the ability and have shown that we can get inflation down to whichever target we choose.
I think the individual from UBS, that essentially was asking us to look the other way, or maybe not give as much merit to that report as other previous reports. As interesting as I was combing through all of the articles for the newsletter over the last 2 months, really in the midst of the government shutdown, there was so much begging and pleading for transparency into core data, and we finally got some. And it's just one individual, but here's just one individual that says, hey, this is just noise. I think, like you said, and if we pull up their chart, the refusal to connect the dots from what would be September to November, I think is kind of laughable. It's like we all understand kind of what went through or what was going on during that period, but the refusal to connect those dots, I think, is a little foolish, just because to get to where we are in November, there's no way we see a spike up so abruptly in October. I don't see that happening. Maybe if you look at January, there was kind of an uptick to go back down in February, but it seems like we could but we could draw a line in between September and November with a little bit of confidence.
Yeah, it's a good point. I was thinking about that too. Yeah, like if you look between December and February in 23 or 24 to 25, there was a little tick up before it ticked down. But again, that's where we come back into, it's not like we don't know what happened in October. And, and it's fine. We're not going to connect the dots because there is no October dot. So we'd have to make a long line down. Mm-hmm. But, you're making lines during period, you're making a line 1 month to the next. I don't see why skipping a month means you can't make a line.
It's just going to make this chart in question for the next 12 to 15 months.
Yeah.
Because now everybody's going to say, well, what about that gap?
But that's where I just encourage everyone and to get out of your head that, we have to, that CPI and that the BLS are the givers of truth.
Yeah, the end all be all, for sure.
The end all be all. When it's like they're using this methodology that may have like a decent calculus and for certain periods and certain environments, and there's thought behind it. But to say, well, we don't know and we can't make decisions because we don't have the data because the one data source wasn't available, I think is really, I think it's kind of immature and doesn't look at the totality of the information and is really a 20th century mindset. Mm-hmm. And it's so backwards. We have so much information that's available to us.
We do.
I mean, this is the age of I can go on ChatGPT and have it do a full analysis on the state of the U.S. economy, and it's going to be able to produce a research report that's pretty damn accurate, just as good as some of the top consulting firms.
Right, in a matter of minutes.
Together. In a matter of minutes. And so again, to say that it's like we need to ignore CPI while I'm discrediting CPI, like we can make some assumptions on our own, and we know what happened in October. The rents were lower. Mm-hmm. So,
yes.
Well, this has been an exciting episode. If you find this stuff interesting, multifamily housing, commercial real estate,
golf,
this is the place to be. The Gray Reports. Make sure you like this video if you found it halfway interesting. The fact that you're still listening, you've been called out. You have found this interesting, or you do not know how to turn YouTube off, which we've all been there. But even so, you're getting the message. You might as well subscribe to the Gray Capital YouTube channel. And if you'd like to learn more about Gray Capital, hop on over to our website, graycapitalllc.com. We try to find really interesting multifamily deals in the Midwest. We're owner-operators. We manage our own properties. We do as much in-house as we can. We really like doing good deals, which means we haven't been doing too many deals lately. So you got to get on the list, because when we do find one, the way we're talking about it is it's going to go quick, because we have a lot of big investors. And this is different from our previous deals, where the vast majority of our capital was raised from like individuals and family offices, always talking to some institutions, but they're like, we want to be able to control your deal, do all this stuff. And we're like, we've got all these people that want to invest with us. We don't necessarily need you. We've got a couple groups that are making some pretty attractive offers, and so they may take up like 80% of the capital on a deal. And so we're going to have less money to raise from our normal retail investors. We'd like to have many deals, so everyone still gets in. But this is we may be approaching a period of time of where when we say, hey, Gray Capital, we've got a deal, hop on, subscribe. It's not let me know when you're almost raised. Let me know in a month. It's going to go within a week or less.
The deals are scarce. The capital equity availability in our projects may be even more scarce.
What I'm looking forward to, because of that, exactly what you said, we can kind of handpick all of our favorite investors.
Right. Play favorites. I'm excited about the next project that we have in-house. Like Spencer said, we've got some significant programmatic check writers that are looking to take up a sizable portion of our equity. With that being said, our existing investor network will likely have first come, first serve rights.
100%.
But we also really value the opportunity to create new partnerships and new relationships. So if you're interested in partnering with Gray Capital on a future project, preferably our next one, we'd love to have that discussion just to get your name in the hat.
What you don't want to do is, you've been subscribed to our YouTube channel for a while. You've been listening to the Gray Report podcast. You've been thinking about investing with Gray Capital. You're a accredited investor, which that's key.
That's key.
Thanks, SEC. Then you're like, I want to talk to these guys about it. But then, no one likes to commit to an investment. You're investing $100,000 on the first call. You're going to want to think about it. Griffin, he's going to try to close you because he's good at what he does. But it's reasonable for you to say, hey, let me take this back. Let me consult all my advisors, my consultants, my team, my attorneys, all of the people in your corner. And it's going to take some time. What I'd recommend you doing is having the call now, sooner rather than later, before we have a deal. Let us get to know each other, get to know Gray Capital, have a conversation with Griffin, Blake, myself. We understand what your goals and objectives are. You make sure that Gray Capital is the right fit. We make sure that we're a good fit for each other. Once you kind of checked that box, you kind of know how we structure our deals, what they look like, what our last deals were. Then when we do have an opportunity, we know that you're ready to go. We know who you are, that you're a known quantity, and you're going to get pushed up on the list. And at that point, you don't have to do the whole getting to know you. It's tell me about the deal. Let's break it down. I've gotten all the materials. You'll be ready to make a decision before everyone else is committed. So don't wait until we have a deal. Schedule a meeting with Griffin. Get access to our investment portal at graycapitalllc.com. You can start going through, filling out all of your information. You can be ready to go. And then when we do have a great opportunity, early in 2026, you are primed and ready. You're not going to miss out on the opportunity. We're looking forward to an exciting year. I'm not saying there's going to be a lot of deals, but we will have a few deals, at least one or two. And I am just bullish on the vintage of 2025 and 2026 real estate deals. There will be some great opportunities that in 2030, 2035, we're going to be looking back and saying, those were the good old days. Just like over the last couple of years, it's like, wish I could go back to 2009, 2010, 2011 to buy all the real estate that I could. We're going to be saying the same thing. The real estate has been kind of out of favor for the last couple of years. We saw the fear and greed index. Well, I believe, like many things in the universe, there's cycles, and business cycles are no different. Real estate cycles are no different. I think people are still going to need a place to live over the next 10 to 15 years. And I think capital markets are smart enough to understand where to allocate resources. So hop on the train with us. It's a great opportunity to invest with some experienced operators that put their own money into their deals. We're vertically integrated. We try to do the right things and occasionally have a little bit of fun while we're doing it. Griffin, Happy New Year.
Happy New Year. That's a wrap on 2025.
Let's do it. Thanks.